Yeah, okay, this. By the way, as we start through this, I invite you to take the position, if you wish, either as the executive or as the owner. Or both, if you want, as you may trigger questions later on in the evening or our presentation. Because if you're sitting in the seat and saying, well, what we're talking about is, and I'm in this position, how does this impact me? So, okay, so on the buy-sell, let's see if we can do this. I'm not a lawyer, I'm not an accountant, but we are talking about transferring. And there are different techniques of transferring ownership of the business. In the event of, and here are the triggers, death, disability, or retirement. Before you can do a buy-sell agreement or payout, there has to be an effective valuation. And Diana talked about that example of a bad contract that had never been updated. So either the attorney or the financial advisor for the business or somebody didn't get involved to update the language in the contract to keep it current. So a fair valuation is the beginning, and then how do you get to it? Let me go back one. Fair valuation, prompt settlement, and then it will relieve the involved parties from a lot of business worries of what am I going to get? For the surviving owners of the business, they want full control. Now, I hate to use my own family as an example, but I had two sisters-in-laws that just lost their husbands, and they thought that the cash flow were going to continue to them just like it was to my brothers. But the fact is they were not contributing to the business at all. They were adding nothing to the business. We love them entirely, but the two surviving brothers, by the way, I had nothing to do with any of this, other than I tried to encourage a buy-sell agreement years before any death. But they didn't do one. And so it took 2 or 3 years, and they went back and forth discussing, negotiating, arguing, use anything you want, what the value of the business was, until they finally reached, we'll say, a settlement. And then there was the funds were transferred, and the two surviving brothers went on with the business. So, there are issues in running a business and succession planning, particularly if there's a death, disability, or a retirement. So, let me press on here. The agreement settles the terms and provisions of the transfer. If it's not written down, there's nothing to codify the arrangement. Guarantees a buyer, fair market price, estate value tax, peace of mind. Okay, so we'll press on. I don't want to get too much in the weeds because we've got some other material to cover, so I'm going to press on with a quick overview of types of buy-sell agreements. The cross purchase is, in this business, there are two owners. Owner A and owner B. It looks like a 50-50 ownership. They each own 100 shares. Owner B dies. Well, in a cross-purchase agreement that is funded with life insurance, A owns a policy on B, B owns a policy on A. In this case, in this example, B dies, and A receives the death benefit proceeds from the insurance company. Now at this point, because there's already agreement in place and the business is valued, A writes a check to the survivors, B's estate, and B's estate transfers the share to A and now A owns 100% of the business. Pretty basic. But what happens if there's more than 2 owners in the business? Because in this situation, there are 2 life insurance policies that generated the $250,000. Now, if there is no life policy, there's an obligation to pay, either from an installment agreement or go take a loan from a bank or what. We're going to get into some other slides on that in a minute. But here is what they call a stock redemption plan. And in this case, there's 3 owners. Now, they could still do a cross purchase, but it would take 6 policies, 3 times 3 minus 1, or 3 times 2. It takes 6 policies to do the cross purchase. So in this case, there are 3 policies, all owned by the company instead of the individuals. So in this case, the death benefit proceeds come back into the company, and from the company, the shares are transferred, the money is transferred, and the business continues on, and everybody's kept whole. The only thing that's missing from this is this type of stock redemption buy-sell agreement. There's no stepped up in basis, and that's some accounting jargon, that is forfeited. But it still works and is used every single day. So we already talked about how important it is to get a good business valuation. Some people think maybe book value. For some purposes, book value may be important, but if you're trying to sell the business, you want to sell it for the greatest value, maybe market value or appraised value. But
and sometimes the business owner has 2 sets of books. One is to minimize the tax obligations and things that they have, and the other one is the value to sell the business. So it can be a conflict there as well.
Okay, so buy a sell agreement and fund it. So we're good. Here's alternatives if you don't use life insurance. Personal funds, bank loans, sinking funds, installment agreements. I'm going to jump forward again because we have some other topics to cover in our 45 minutes, but I want to show you this one slide without going into all this detail here. And this is the part, this is where Diana and I come in. Examples comparing the cost per dollar of a buyout versus the alternatives. Now this is assuming a relatively healthy person. If they're unhealthy and still insurable, it might be 11, 12, 15 cents or 25 cents. But any of them is cheaper than the alternatives, even if you're not in perfect health. So that's it that I wanted to cover today on the, okay, well, the other part of the buy-sell, and Diana started on that in her introduction, is what about disability? Well, we can do disability buyouts for the owners. So you don't have to die for the shares to be transferred. How would you like to have a partner? I mean, it'd be a shame. They're in a wheelchair, they can't really contribute at all to the business, and they're still an owner. So a disability buyout is also a possibility to consider. Okay, so I'm going to press on from that. Let's see if we can get this to come back to another PowerPoint. Let's go to executive bonus. Does anybody know what executive bonus is? Besides Diana's just brief introduction. There's a section in the Internal Revenue Code, section 162, that allows business owners to set up discriminatory benefits for the highly compensated, legally. We generally think of employees under group benefits, group health, group disability, group maybe group long-term care, group benefits. But the problem with that is the reverse discrimination for the highly compensated. The highly compensated will not be able to retrieve the same cash flow in the event of a disability, for example, from the salary that they're earning, because the group benefit has a ceiling. A $5,000 a month ceiling or a $10,000 a month ceiling may only represent 30% of what they're making. So what we are able to do under Section 162 is install both retirement accumulation products like life insurance, which I'll show you in a minute, and we can also do disability. Let's see. So in this case, we're going to talk about accumulation goals. Now, the executive bonus in its simplest form is a bonus, maybe on top of a salary, that can be transferred to the executive, and the business gets to deduct that transfer, whatever that amount is. And it could be $10, $15, $20, $50,000 a year, depending upon what the executive's making. It's big money. It's not like $1,000 a year. And the business can deduct that expense from their business income. Now, what does the executive get? The executive gets the money, but has to report it on their W-2. They have to pay ordinary income tax on it. So it's a powerful fringe benefit that's the beginning of attracting, retaining, and rewarding key people. They could be officers, they don't have to be owners. They could be decision makers like senior management, non-owners. The owners could do it for themselves. In C corporations, they can do it. The C corporation gets a deduction. If it's a pass-through entity like an LLC or an S, they don't get the deduction. But non-owner employees can. Okay, so wouldn't you like to take steps to retain, really recruit? I understand what the millennials are not quite as loyal to as our parents or our grandparents were to staying with your employer for 30 or 40 years. So this is really attractive for somebody that's going to work 20, 30 years, and you really want them. They're IT specialists, they're engineers, they're scientists, they're whatever. They're important to the operation of the business. And the idea is we want to find a way for the employer to put the golden handcuffs on the employee. Well, in the simplest form, the executive bonus doesn't do that explicitly, because what we're going to be talking about is ownership. The business owner attracts the best of the best, key employee retention and motivation. Okay, there's the tax deduction. We use a life insurance contract because there really is no other way. I guess you could set up a brokerage account, but there's no leverage in it and there's no portability. And it will not generate the income tax-free death benefits, that the life insurance policy will generate.
I just want to insert something right there.
Yeah.
On number 3, creditor protection. There aren't that many states that offer creditor protection for these plans. New Mexico has creditor protection as well.
Yeah.
At 100%.
No ceiling. Okay, so we create a tax-deductible business expense, accumulate money in a tax-deferred basis, and provide benefits for retirement, disability, and death. And we avoid the worst features. Qualified plans. What's the negative of qualified plans? Well, the ceilings are too low. If you're making $250,000 a year and you can only put in whatever the current ceiling is, $22,000, that's too low. You'll never be able to fund your retirement with such a low ceiling. So we need to supplement the qualified plan, the 401k. Some comparisons of fringe benefits to the qualified plan. What we talk about is the tax-free income. This talks about the reverse, let's see, a level playing field to make up for the reverse discrimination of really large salaries. And some business owners do take very large salaries. Okay, so the basic executive bonus, the executive is the owner of the contract. They're the owner of whatever the product is that goes in. That doesn't put golden handcuffs on anybody. It's just an enticement or encouragement to stay. So another way to do this, I want to advance forward here to the custodial executive. And this is where we get into the employer having a stake in the contract or in the arrangement. The employer can place restrictions on the employee, like a vesting schedule. You have to stay 5, 10, 15, 20 years, and each year, just like in your 401k, the match, the vesting, the executive qualifies for whatever the account values are. If the executive leaves during the vesting schedule, the part that they are vested, they can take with them, and the rest stays with the employer. So that's a quick flow chart of the arrangement. So how is this accomplished? The executive still owns the contract, but there's kind of like a collateral assignment or a lien against it to the extent that the employer owns values from the contract. Okay, so when to use custodial executive bonus? Prevent competitive startup by the executive, give the employer control over the exercise of ownership rights. Really, it's a veto. The owner can limit what the executive does with the contract. Okay.
Did you want to go over there?
Yeah. All right. So I created this outside and just inserted in the PowerPoint. What's important here is to see on the right-hand side, it's all about control. The executive bonus, the executive owns the contract, has to pay the tax, but owns all the benefits. The double bonus is just a term used that the business double bonuses to cover the tax that's due on the first increment, but the executive still controls the entire contract. On the other end of the spectrum are the different design plans. Some of these are terms that you hear in a generic sense, a non-qualified deferred comp. All of these deferred comp plans, supplemental executive retirement plans, SERP, salary deferral plans, 401k lookalikes, they're all employer-controlled plans offered to attract, retain, and reward highly compensated. The difference is all of these plans, since they're owned by the company, are subject to the general accounts. They're subject to claims to creditors. And so generally, these plans are only implemented with larger companies, publicly traded companies, or large private companies, because their general accounts are subject to creditors, liquidation, bankruptcy, anything. So in the middle, the industry term is called split dollar arrangements. And now we're talking about restricted executive bonus, like we were talking about on the previous slide. And this is basically a design of the sharing between the employer and the executive of the benefits of the plan. The living benefits, which would be retirement income, disability, or death benefits. For life insurance, it'll be the death benefits or the cash values, the living benefits. So, we've talked about a double bonus. How are we doing on time?
15 minutes.
We have 15 left?
Let's go to
Okay.
the key person.
Okay, all right. Let's see if I can find this.
Because a lot of times what people do, our business owners do, is they insure their machines, they insure a lot of things in the business, but they fail to insure the key people, the ones that bring in the revenue and the profit.
Okay. Key person insurance is initiated by the employer. The executive doesn't say, I'm a key person, you know, but the business does. It could be a key salesperson, or it could be a key IT person that does programming that impacts the revenue for the business. And what would happen to the business if that individual got injured or died? Well, there'd be a loss of revenues. It would impact the bottom line and the top line of the business. So it's a lot like property insurance, but now we're talking about humans and not capital equipment. Okay, so who's a key person continued? High salary people, decision makers, people that can implement.
Top salespeople.
Top salespeople. Somebody with unique talents that's not easily replaceable. Okay, so what are the challenges? Disrupted management, reduced earnings, impaired credit, replacement cost, confidence. And the business needs cash to fulfill obligations while they're adjusting to this event, whatever it is. And by the way, these events do happen.
Could it also be that they left?
Yes. Now, we didn't put the golden handcuffs on the other plan to get them to stay, but even with that, they may leave. They may still leave, and it could be a problem. But whatever it is, the business is valuing what that person or group of people contribute to the operations. And so what do? No set rules exist for determining how much coverage is needed. It is subjective. Just because a salesperson brought in $1 million of revenue last year doesn't mean he will next year. And, you know, if some new product is being manufactured or created or designed, that doesn't mean it'll continue. But some valuation has to be put on. So step one, set a value of some kind. Now, this is another point. On key person insurance, the employer must notify the employee that we're going to purchase insurance on that individual. You cannot do it secretly behind the executive or the key person's back. They have to be advised of it. When it's insurance, they'll be advised of it because they're going to go through underwriting. The business is the owner and the beneficiary of the contract, and they will also pay 100% of the premium. the key person has no benefits to this contract, zero. If a death occurs, the benefit's paid to the business, and now you have capital set aside to go out and recruit a replacement, pick up lost operating income. Okay. And that's it. Business owns and controls the policy. Business is the premium payer and beneficiary, and the business receives a tax-free death benefit. Why life insurance? It's a multiplier. You put in a little, there's always more on the death benefit than what you put in. Employee has no rights. Premium payments by the employer are not tax deductible, but they do own the cash value and they can use it as additional short-term cash, quick cash if they need it. Okay, that's into some detail we don't need to get into. But there's one thing I wanted to point out. Now, we looked at executive bonus and we looked at key man. And we said the term split dollar, but what can be done is mutual goals can be accomplished inside one contract. You just make it a little bit bigger. This part over here is for the employer on the key man side that we just finished. This part over here represents the benefit to the executive for his family, retirement, protection. So you can do it all inside one contract if it works out. And that's where the benefits, both the death benefit and the living benefits, are shared between the employer and the employee.
And sometimes the employer can retrieve all of the premiums that they paid during that period of time too.
Okay, so what are the alternatives to key man insurance? Sinking funds, borrowed funds, U.S. surplus, whatever. So
I think in the interest of time, I think that's probably,
time's up.
yeah.
Okay.
But you can see on the handout that there are so many ways and reasons to help the business owner or the highly compensated executives. I mean, if you look at the different designs, there's quite a few. I mean, we're just scratching the surface here.
We're just scratching the surface of what can be done for the business owner or the executives. And each case is different. That's why we have to do a lot of fact finding and see what their goals and what their plans and goals are. Do they have plans? Most business owners, I don't care how big the business is, sometimes they don't have the plans in place that they need.
So you would just start out looking at what they've already got and then what they hope to accomplish. And it almost sounds like every single situation would have to be customized based on what that business owner or group of owners has in place already. Or
Absolutely. But again, like the $11 million mistake, if someone tells us we already have a buy-sell agreement in place, well, when was the last time it was reviewed?
right, you want to look at it.
You know, what does the language say? Because that was a huge case.
Diana, can you give us an example of a recent client, like a story, the scenario of what did you find? What did you guys end up recommending for that company? Something that would give us an idea.
I've got one. I just now thought of that with that question, Maria. This is a real life example. Maybe I can make this a little bit bigger. It's hard to read.
But that's not a real case.
Yeah,
Not our case.
Huh?
Not our case.
Not from ourselves. But let me just share this real quickly and I'll get back. I know we're short on time. This split dollar plan article came from, I don't know what the publication was, but it's a true story. The head football coach at the University of Michigan is Jim Harbaugh. He took the job when he left Stanford years ago. They hired him on a multi-million-dollar contract, but they implemented a split dollar arrangement where the university is going to fund, I know you can't see this, $2 million a year, $4 million in the first year, and $2 million a year for the next 5 years into a life insurance policy. The university gets part of the death benefit and part of the cash value, and Jim and his family will own the other part. So this is a case of a split dollar arrangement on the lines of what we've been talking about in real life for a highly compensated individual. This is done in corporate America all the time.
So that life insurance policy is part of his compensation package,
Yes,
so that they don't have to just pay him $4 million a year in cash.
right.
They're paying him some smaller salary plus this plan.
Well, in this case, his base salary was $5 million.
Okay, right.
But you're right, the $4 million plus the 2 for years 2 through 5.
Right.
uh,
But it doesn't cost them $2 million to fund a $2 million plan.
No, they're putting that much money into the policy every year.
It's probably a $75 million.
Yeah, the article says
Yeah.
they're estimating the death benefit around $75 million.
Okay. So his total compensation then becomes
Well,
much bigger than a $3 million or $4 million plan plus
Without getting
$5
into the
million
weeds.
salary.
the deferred this will be owned by the employer, the university. So he will not be paying tax on those premiums.
Right.
He'll be paying tax on the back end when he retires and earns the benefit.
Right. Okay.
Yeah,
The
okay.
university gets.
But the university's got their, yeah,
They've got
they got,
handcuffs.
everybody's got skin in the game.
Right.
So,
We have 4 more minutes. Any other questions?
Well, we'd like to thank you very much for listening and hope it was informative and educational.